Ever wondered how changes in interest rates affect your investments? In this video, we'll explore the relationship between interest rates and stock market performance, and what it means for you as an investor. Section 1. Understanding interest rates. Interest rates represent the cost of borrowing money, set by central banks like the Federal Reserve. They influence economic activity by making borrowing more or less expensive. Section 2. Direct impact on companies. Borrowing costs. Higher interest rates increase borrowing costs for companies, potentially reducing profits and leading to lower stock prices. Consumer spending. As borrowing becomes more expensive for consumers, spending may decrease, affecting company revenues. Section 3. Investor behavior. Higher interest rates can make fixed-income investments like bonds more attractive, leading investors to shift away from stocks, causing stock prices to decline. Section 4. Sector-specific effects. Financial sector. Banks may benefit from higher rates due to increased lending margins. Utilities and real estate. These sectors often suffer as higher rates increase debt servicing costs. Section 5. Historical perspective. Historically, rising interest rates have led to short-term stock market volatility, but markets often adjust as the economy stabilizes. Section 6. Strategies for investors. Diversification. Spread investments across asset classes to mitigate risk. Focus on quality. Invest in companies with strong balance sheets that can withstand higher borrowing costs. Stay informed. Keep abreast of monetary policy changes to anticipate market movements. Understanding the impact of interest rates on the stock market is crucial for making informed investment decisions. If you found this video helpful, like and subscribe for more insights into the financial world.